All right, let's jump right in. Today, we're talking about something that can completely transform your financial future. We're talking about building real, lasting wealth. And you know what? It all starts with understanding one simple, powerful idea: acquiring assets.
So let me ask you a question, and I want you to really think about it. Are you working hard for your money, or is your money working hard for you? Seriously, that one little shift in perspective, it's the key to pretty much everything we're about to dive into.
And it all boils down to this super simple but incredibly important difference. An asset, well, that's anything that puts money in your pocket. And a liability, that's anything that takes money out of your pocket. That's it. This isn't just some boring financial jargon. This is the actual blueprint for building financial security.
Okay, so let's stick with that idea of a blueprint. Because once you start seeing the world through this lens, asset versus liability, your whole approach to money it changes. It stops being about just earning and spending, and it becomes all about building something real. So here's the game plan, right? The main goal is to use the money you earn to buy assets. And not just any old thing, but assets that are going to generate even more income for you or grow in value over time, or, hey, ideally do both. This is exactly how you stop being a slave to your paycheck and start making your money work for you.
So, how do we actually do this? Well, I want you to think of yourself as a builder, and these different types of assets, they're the essential tools in your toolkit. Every tool has a specific job, and knowing how and when to use them is what turns a shaky financial shed into a solid skyscraper.
First up in the toolkit, we've got stocks. When you buy a stock, you're buying a tiny piece of a company. Think of stocks as your power tool for high growth. They have the potential to deliver some really big returns as the company does well. Now, the flip side is they can be volatile, a little risky. But they're also super liquid, which just means they're easy to buy and sell. Next up, real estate. This one's a tangible asset. You can literally go and touch it. Its superpower is that it can give you a nice, steady stream of rental income month after month, all while the property itself hopefully grows in value over the long haul.
And then we have bonds. The easiest way to think about a bond is like you're giving a loan to a big company, or even the government. And in return for that loan, they pay you regular interest. Bonds are kind of like the stabilizing tool in your kit. The returns aren't usually as high as stocks, but the risk is a lot lower, which makes them awesome for protecting your money.
Okay, but just like any good builder knows, you can't build a whole house with just a hammer. You need to know which tool is right for the job. So let's put our main tools side by side and see how they really compare.
Now this is where it gets really interesting, because you can see the trade-offs. Look at stocks. High potential return, but also high risk. Bonds are basically the opposite. Low risk, but that also means lower potential returns. And then you've got real estate, kind of sitting in the middle on risk and return. But notice that last column, liquidity. It's low from real estate. That just means you can't turn your property into cash as quickly as you can sell a stock or a bond.
And this chart here, it just shows that core idea perfectly. If you want a chance at higher returns, you generally have to be willing to take on more risk. See, a savings account is super safe, but you're barely going to earn anything. Bonds give you a little more return for a little more risk. And way up at the top, you've got stocks, offering the biggest potential for growth, but also the biggest potential bumps along the way.
Okay, so you've got the blueprint, you know what the tools are, now you need the instruction manual. How do you actually put all this together and use these tools to build wealth the right way? Let's get into the actual strategies. We can really boil it down to 3 absolutely critical steps. First, diversify your tools. Don't just rely on one thing. Spreading your investments around is key to lowering your risk. Second, and this is a big one, you have to reinvest your earnings. And third, you've got to keep an eye on your costs. Now that second point, reinvesting your earnings, that's where the real magic happens. This quote says it all. Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. It's so true. When you reinvest what you make, your earnings start making their own earnings. It's like a snowball rolling downhill. And the results, well, they're just staggering. Look at this. A single $1,000 investment, just left alone to grow at about 7% a year, turns into more than $7,500 after 30 years. But here's the part that'll blow your mind. Almost 90% of that final amount is pure growth. Your original $1,000 is just a tiny piece of the final pie. This is how you literally build wealth while you sleep. Time is your best friend here. And beyond those big 3, you got to remember to think long-term. This isn't a get-rich-quick scheme. It's a marathon, not a sprint. It's also super important to check in on your plan every so often, maybe once a year.
just to make sure everything's still on track. And finally, if you do get into real estate, learn how to use leverage smartly. It can seriously boost your returns, but it also boosts your risk, so you have to handle it with care.
Of course, any construction project has potential dangers, right? In the world of finance, these are the costly mistakes that can totally wreck your progress. So let's look at a few big warning signs to watch out for. The first huge mistake is overconcentration. It's that old saying, putting all your eggs in one basket. If all your money is tied up in one single stock or one type of investment, and that one thing takes a nosedive, your whole financial house could come crashing down. You have to spread the risk around.
Next up is ignoring fees. Oh man, this is a silent wealth killer. They might seem small, like 1 or 2%, but over decades, those little fees can eat away a massive chunk of your returns. It's like the terrifying opposite of compounding. Always know what you're paying in fees.
And finally, please, avoid the temptation to chase quick gains. Treating the stock market like a casino, jumping in and out, trying to time things perfectly, that's not building, that's gambling. True, sustainable wealth is built patiently, over the long term, by owning quality assets.
So there you have it. The blueprint is simple. Buy things that put money in your pocket. The tools are things like stocks, real estate, and bonds. And the instruction manual is your strategy. Diversify, reinvest, and keep your costs low. The only question left is, what are you going to build first?